There's a moment in every financial collapse when ordinary people discover that the promises made to them were never meant to be kept. In Detroit, that moment came in 2013. Retired police officers and firefighters who had worked their entire lives for the city woke up one morning to find their pensions had been cut by 60% overnight. Not reduced, cut. The money they had been promised for 40 years of service simply vanished into accounting ledgers that had been lies from the very beginning. Detroit wasn't an anomaly, it was a preview. What happened to those Detroit retirees is about to happen to 100 million Americans. Not because of corruption, not because of incompetence, but because of simple mathematics. The promises that have been made cannot be kept. The numbers do not add up. They never did. Right now, there are three systems that millions of Americans depend on for their retirement security. Social Security, which manages $2.9 trillion in supposed reserves, corporate pension funds, holding another $19 trillion in assets, and public employee pensions, managing $4.5 trillion for teachers, police officers, and government workers. Combined, these systems represent over $26 trillion in retirement promises. Here's the problem. That $26 trillion represents what's been promised. What actually exists is something very different. To understand how this ends, you need to understand how it began. Because this exact scenario has played out before. Not once, but repeatedly across different countries and different decades. The pattern is always the same. In 1998, Argentina had a pension system that looked remarkably stable. Private accounts, government backing, international oversight. Millions of Argentines had been paying into the system for decades, trusting that their retirement was secure. The government promised that their contributions were safe, that the system was fully funded, that there was nothing to worry about. In 2001, facing a debt crisis, the Argentine government did something unprecedented. They seized the private pension accounts. Overnight, they converted private retirement savings into government bonds. Bonds that, within months, became worthless paper. Retirees who had worked their entire lives found themselves with nothing. The government called it a temporary emergency measure. It was never reversed. In Cyprus in 2013, the same pattern emerged. Bank deposits, including pension funds, were subject to what officials called a bail-in. Savers lost up to 60% of their money. The European Union called it necessary to prevent systemic collapse. Depositors called it theft. The money was simply gone. The mechanism is always the same. A crisis emerges. Emergency powers are invoked. Private savings are converted into government promises. And government promises, in a crisis, become worthless. Now look at the United States in 2024. The Social Security Administration's own trustees report states that the trust fund will be depleted by 2033. When that happens, benefits will be automatically cut by 23%. That's not a prediction. That's current law. But 2033 assumes that nothing goes wrong between now and then. It assumes steady economic growth, consistent employment levels, and no major financial disruptions. It assumes that the Treasury bonds held in the Social Security Trust Fund retain their value and can be sold to pay benefits. Every one of those assumptions is questionable. Corporate pension funds are in even worse shape. Boeing's pension plan is underfunded by $31 billion. General Electric's shortfall exceeds $15 billion. Ford's deficit is over $12 billion. These are not small companies with small problems. These are industrial giants that have promised more than they can deliver. The Pension Benefit Guaranty Corporation, which is supposed to ensure private pensions, is itself facing insolvency. They currently guarantee about $1.5 trillion in pension benefits, but they have only $133 billion in assets to back those guarantees. When large corporations dump their pension obligations onto the PBGC, as they inevitably will, the insurance system will collapse, along with everything it was supposed to protect. Public pensions are the most dangerous of all. Illinois has promised $317 billion in pension benefits, but has funded only 39% of that obligation. New Jersey has funded just 26%. California's giant public employee system has unfunded liabilities exceeding $1 trillion. These are not accounting discrepancies. These are mathematical impossibilities. The mechanics of pension fund collapse follow a predictable sequence. First, returns fail to meet assumptions. Fund managers have been assuming 7 to 8% annual returns for decades, even as bond yields collapsed and stock valuations reached historic extremes. When reality delivers 3 or 4% instead, the shortfalls compound exponentially. Second, demographics accelerate the drain. Every retiring baby boomer represents a shift from contributor to beneficiary. The ratio of workers to retirees, which was 16 to 1 when Social Security began, is now approaching 2 to 1. By 2030, it will be even worse. Simple mathematics dictates that fewer workers cannot support more retirees indefinitely. Third, political paralysis prevents necessary reforms. Cutting benefits loses elections. Raising taxes loses elections. So politicians choose the only option that doesn't lose elections immediately. They lie about the numbers and push the crisis into the future. Greece demonstrated this pattern perfectly between 2010 and 2015. Their pension system promised benefits that consumed 17% of GDP, twice the European average. When the mathematics finally caught up, retirees saw their pensions cut by 40% overnight. Protests filled the streets, riots erupted, but the money was simply gone. No amount of political pressure could resurrect funds that had never actually existed. The Greek crisis wasn't caused by laziness or corruption, despite what media narratives suggested. It was caused by the same mathematical impossibility now facing American pensions. Promises were made based on assumptions that could not be sustained. When reality diverged from assumptions, the system collapsed. But here's where it gets truly dangerous. All of these systems are interconnected. They all depend on the same underlying assumptions: economic growth, market returns, and most critically, faith in government promises. When one system breaks, it destroys confidence in all the others. When people realize that Detroit wasn't unique, that pension cuts are not anomalies but inevitabilities, panic sets in, and panic accelerates the very collapse that everyone fears. The timeline is already visible. Illinois has been issuing pension bonds, borrowing money to make pension payments. This is the financial equivalent of using credit cards to pay credit card bills. It cannot continue indefinitely. California has been moving pension money into increasingly risky investments, chasing higher returns to make up for decades of underfunding. Private equity, hedge funds, overseas real estate, these are not the conservative investments that pension money demands. They are desperate gambles by fund managers who know the math doesn't work. At the federal level, the situation is even more precarious. The total unfunded liabilities of the U.S. government, including Social Security and Medicare, exceed $200 trillion. That number is so large that it represents more than 10 times the entire U.S. economy. There is no scenario, under current law, where these promises can be kept. The response from policymakers has been predictable. They push the problem into the future. They adjust the assumptions. They change the accounting methods. They do everything except acknowledge the fundamental reality that the promises cannot be kept. This is exactly how every pension crisis in history has unfolded. Denial, delay, then collapse. The year 2026 is significant for several reasons. It marks the point when Social Security's cash flow deficit becomes severe enough to require massive Treasury intervention. It coincides with a wave of corporate pension plan terminations that have been building for years. And it represents the moment when public pension systems in multiple states will face simultaneous funding crises. More importantly, 2026 is when the baby boom generation's retirement wave peaks. Every day, 10,000 Americans turn 65. That number will accelerate through 2026 before beginning to decline. The system is facing maximum demand at exactly the moment when its funding is most vulnerable. The trigger could be anything: a stock market correction that devastates pension fund assets, an interest rate spike that makes government borrowing unsustainable, a recession that reduces the tax revenues needed to support the system, or simply the mathematical reality that exponential growth in pension obligations cannot be sustained indefinitely. Consider what happened in 2008. Pension funds lost $2.4 trillion in a single year. That wasn't gradual decline. That was instant devastation. Funds that had been 80% funded dropped to 60% overnight. Recovery took a decade, and only because central banks printed trillions of dollars to inflate asset prices back to artificial highs. The next crisis will be worse because the starting point is already compromised. Pension funds today are more underfunded than they were in 2007. Government debt is higher. Central bank balance sheets are already bloated from previous interventions. There are no reserves left for another rescue. Even more dangerous is the derivatives exposure hidden within these systems. Pension funds have become massive participants in complex financial instruments they don't fully understand. Interest rate swaps, credit default swaps, synthetic securities tied to everything from corporate debt to foreign currencies. When counterparty failures cascade through these interconnected markets, pension funds won't just lose their investments. They'll face margin calls and collateral demands that could wipe them out entirely. The Bank for International Settlements estimates that global pension funds hold over $78 trillion in derivatives exposure. That number dwarfs their actual assets. It represents leverage on a scale that makes 2008 look conservative. When it happens, it will happen fast. Pension systems don't gradually reduce benefits over decades. They face sudden, catastrophic shortfalls that require immediate action. The action is always the same: emergency powers, temporary measures, and the conversion of private promises into public worthlessness. The people who will be hurt worst are not the wealthy, who have private assets and alternative income sources. They are the middle-class retirees who did everything right, who worked for decades, paid their contributions, and trusted the system to keep its promises. They are the teachers who chose lower salaries in exchange for pension security, the police officers who assumed their dangerous work would be rewarded with dignified retirements, the factory workers who believed that corporate promises were binding contracts, The nurses who worked double shifts for 30 years, counting on their state pension to provide basic dignity in old age. In Japan, this demographic catastrophe has already begun. Their pension system, once considered a model of stability, now pays benefits so low that elderly Japanese are returning to work in massive numbers. 70 and 80-year-olds stock shelves in convenience stores not by choice, but by necessity. The system didn't collapse dramatically. It simply became inadequate, forcing an entire generation to work until death. That quiet desperation, that grinding poverty disguised as policy, is America's most likely future. These people have no backup plan. They have no private wealth to cushion the impact. When their pensions disappear, they have nothing left. The cruelest aspect of this crisis is that it was entirely preventable. The mathematics were always clear. The unfunded liabilities were always growing. The demographic pressures were always predictable. But every year, the problem was pushed into the future, made worse by delay and denial. Now the future has arrived. The signs are everywhere for those willing to see them. Corporate America has already abandoned traditional pensions for most new employees. Public pension funds are desperately chasing yield in dangerous investments. Social Security trustees are issuing increasingly dire warnings about the system's solvency. But the most telling sign is the silence. Politicians don't campaign on pension reform. Corporate executives don't discuss unfunded liabilities in earnings calls. Union leaders don't prepare their members for benefit cuts. Everyone pretends that $50 trillion in unfunded promises will somehow, magically, become funded. The financial media participates in this conspiracy of silence. When pension funds report their annual numbers, the focus is always on investment returns, never on the growing gap between assets and liabilities. When corporations announce pension plan terminations, they're framed as restructuring moves, not as admissions of insolvency. Even the ratings agencies, whose job is to assess financial risk, consistently underestimate pension fund dangers. They use outdated models and optimistic assumptions that have been wrong for decades. Moody's still rates Illinois bonds as investment grade despite pension liabilities that guarantee insolvency. It's 2008 all over again, with the same agencies providing false comfort about risks they refuse to acknowledge. History suggests otherwise. Every similar crisis has ended the same way. The promises are broken, the people who depended on them are abandoned, and a new system emerges from the wreckage, built on the ruins of the old one's credibility. The only question remaining is whether Americans will recognize the pattern before it completes itself, or whether they will discover, like the retirees of Detroit, that the promises made to them were never meant to be kept.